Good morning, Trinidad and Tobago, and welcome once again to the Bourse Report. The festivities are over, the Christmas, the New Year's, the Carnival, and so we focus, as we normally do, much more critically on our investment portfolios, our savings and investment. And over the past 3 or 4 weeks, we have been doing a series speaking to moving from a passive saving framework to a framework which is more active and focused on building an investment portfolio for every person interested in growing that wealth. And we have gone through the conservative investor portfolio, the moderate investment portfolio, and the aggressive investment portfolio. But put more succinctly, the person who, on a ranking of 1 to 10, who is conservative might be somewhere from 1 to 3. The person who is moderate in terms of capital appreciation versus just simply a savings framework I would put somewhere in between 4 to about 7. And the person who is very aggressive, more towards capital appreciation, more towards equity, I would put them in the category of about 7 to 10 in that swing or in that pendulum. How have they performed over the years? Let us look back and do a comparison from 2010 to 2015 and what it means to you as an investor. So when we go to the first graph, we would see those 6 years over the period. And what you would see is that the green is the aggressive investor, red is conservative, and red is moderate and blue is conservative. And when you look at that particular, frame, as I said, moderate is blue, red is conservative. What you would see is there were years when the aggressive investor would have done much better, for example, in 2010 and 2013. And there were years when others would have done better. This is because if the market is pushing up on the equity side, what you would find is that the investor who is more linked towards equity would gain significantly from the capital appreciation and so on. And so, if you come back to me, for that period, what you would have seen is that the market was up in the vicinity of about 30% plus to 35% for each of these investors over the 6 years. And I say this to you because when you compare that, if you had your money just in the bank getting 0.36% to 0.25%, you would have been much worse off over the entire period. Notwithstanding that 2015 was a negative period, what you would have seen is that your, let's say, $100,000 would have translated over the period to $130,000 to $135,000 in each of these portfolios, whereas if you were in the bank, you would have been $101,000 or thereabouts, 1.5% up as opposed to 30% up. So these are factors that you have to consider, passive saving to some more focused investment. Let's turn now to the next graph, which I wanted to share with you, which I've spoken about already. What have been the returns? And when you look at the 3 portfolios, which we have already crafted, and you could go to our website at bourseinvestment.com to get more of these details going back the past 3 or 4 weeks as to what has been the performance and the comparison. And when you look at this, what you would see, as I said, on aggregate for the 6 years, 35% in the case of the aggressive portfolio, 31% in the moderate portfolio, and slightly less in the conservative portfolio. What does this translate into an average return? 5%, 6% on the aggressive portfolio. Let's turn very quickly now to lessons learned as we start to wrap up. The first is that you need, as an investor, to broaden your horizon. When you broaden your horizon, what you see is that if you remain invested only in the TT market is actually producing less of a return on a real positive inflation-adjusted basis than, let's say, external markets, the US markets. So let's come back to that graph, that last graph that we had there, and you would see that in the context of that graph, that the red line above shows you how much more an external portfolio only is producing than a TT portfolio only. Therefore, there is need for a mix in the portfolio because of things like access to currency and so on. So broaden your horizons, one. Two, you cannot time the market. So that in 2015, what we had was a situation was an almost perfect storm for the market, and the market was down 3–4% in any portfolio. But over the entire period, it would have beaten your just passive saving approach, as we have already talked about. You cannot time the market. And finally, and most importantly, do not put all your eggs in one basket. Diversify, diversify, diversify. Those are the things that I want to say to you. Look for us on our website at bourseinvestment.com when there is a replay of this particular broadcast that is available, and we give you much more details about how to invest and where to invest. Call us at 628-9100 for any more information that you need. Have yourself a wonderful investment week. This is Subhash Ram Kelawan for the Bourse Report.